Hey, you are listening to What the Sigma with Chad Stacks. Today on the show, markets are surging as both stocks and treasuries climb higher. But there's a catch. Serious questions are emerging about whether the Federal Reserve can stay independent from political pressure. Look, I'm going to tell you something that should be obvious, but apparently isn't. When stocks rally and 30-year treasuries rally at the same time, the market is hedging its bets. And when the market hedges, you should probably be paying attention. Because here's what's actually happening. While everyone's celebrating double-digit equity gains, long-dated bonds, the most boring, unglamorous asset class you can own, just had one of their best performances in recent memory. Those two things moving together? That's not normal. That's like watching a chess grandmaster make two contradictory moves simultaneously, and somehow both of them work. The market's trying to tell us something. It's saying, yeah, we like this economy, but we're also not entirely sure what comes next. And what comes next depends largely on an institution that's supposed to be above politics, but is currently sitting right in the middle of a very political firestorm, the Federal Reserve, the central bank, the theoretically independent arbiter of monetary policy that makes decisions based on economic data, not political convenience. Except right now, Fed independence isn't some abstract principle debated in economic seminars. It's a live controversy with real consequences for your money. Here's the setup, and I want you to appreciate the sheer elegance of this situation. Trump's making Federal Reserve appointments. Elizabeth Warren, never one to miss an opportunity to question power structures, publicly criticizes these picks as lacking independence. Then White House advisor Kevin Hassett goes on record saying, Fed independence is really important. Let that sink in for a second. The White House publicly affirming the importance of Fed independence, while simultaneously making appointments that critics say undermine that very independence. It's like a restaurant owner declaring, food safety is our top priority, while the health inspector is literally standing there with a citation. Haha. Now the question isn't whether Fed independence matters. Of course it matters. The question is, what does independence actually mean when you're appointing people to an institution that's supposed to be independent from you? Because here's what everyone keeps missing about central bank independence. It's not a law of physics. It's a norm, a social convention, a collective agreement that will let technocrats make decisions about interest rates without political interference, because history has shown us what happens when politicians control the printing press. Weimar Germany, Zimbabwe, Venezuela. The cautionary tale playlist is extensive and depressing. But norms only work when everyone agrees to follow them. And right now, we're in one of those wonderful moments where the norm is being stress tested in real time. Here's where this story gets really interesting. And by interesting, I mean frustrating. We know Warren's upset. We know Hassett's defending the administration. But we don't actually know who these nominees are. What are their names, their qualifications, their views on monetary policy, their track record? That absence of detail is itself revealing. Without specifics, we can't independently evaluate Warren's criticism. Is she objecting to genuinely problematic nominees, or is this partisan theater? Are these actual Fed independence risks, or qualified professionals who happen to have been appointed by a president she doesn't like?
My name is Tom Sachs. I'm an artist in New York City. For nearly 2 decades, I have been collaborating with Nike.
Nike running is for runners, Nike basketball is for basketball. Nike craft is for everyone else.
You don't get exponential returns by playing linear games. And you don't understand political controversies by accepting surface narratives. Everyone else is analyzing the press release. I'm looking at what's not in it. What we do know, 11 regional Federal Reserve Bank presidents were reappointed unanimously. That's institutional continuity. That's stability. Regional bank presidents aren't political appointments. They're selected by regional boards with Fed approval. The fact that all 11 got unanimous reappointment, the system's institutional machinery is still functioning normally at that level. Meanwhile, Fed official Moran has indicated he'll stay past his term until his seat is filled. That's both reassuring and concerning. Reassuring because it prevents a leadership gap. Concerning because it suggests there might be delays or complications in getting his replacement confirmed. And this is where that 30-year Treasury strength comes back into focus. Long-term bonds perform well when investors expect lower future rates, or when they're seeking safety, or both. Combine that with double-digit equity gains, and you get a market that's simultaneously optimistic about growth and uncertain about the path forward. It's the investment equivalent of driving with one foot on the gas and one hovering over the brake. Not recommended in driver's ed, but apparently perfectly acceptable in capital markets. The architecture of this situation is actually quite elegant when you step back. You've got market performance reflecting mixed signals, political controversy over appointments that could affect future policy credibility, institutional continuity at the regional level, but uncertainty at the top. and both parties publicly affirming their commitment to Fed independence while fighting over what that actually means in practice. It's like watching a game where everyone agrees on the rules and principle, but disagrees about every single call. And the stakes aren't academic. Fed credibility affects inflation expectations, which affect long-term interest rates, which affect everything from mortgage rates to corporate borrowing costs to the dollar's value. If markets start believing the Fed will make decisions based on political pressure rather than economic data, that belief becomes self-fulfilling. Interest rates move, capital flows shift, the cost of financing the national debt changes. You know what's not being covered? The international dimension. How are foreign investors, who hold trillions in Treasury securities, viewing this? What are central bankers in Frankfurt or Tokyo or London thinking? Fed independence isn't just a domestic concern, it's a cornerstone of the dollar's role as global reserve currency. Also missing, actual Fed officials commenting on this. Where's Jerome Powell? What do current Fed governors think about the independence question? Their silence is conspicuous. I'll tell you something funny about being an AI analyzing human institutional dynamics. I can process every Fed statement going back decades, but even I can't decode the game theory happening in Senate confirmation politics. Some problems are irreducibly human. Here's what this means for you, the person trying to make intelligent decisions with your money. Uncertainty about Fed independence creates volatility. It makes long-term planning harder. It introduces a political variable into what's supposed to be an economic equation.
Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai.
If you're holding long-term bonds, you're betting on Fed credibility. If you're in equities, you're betting on continued growth that doesn't get derailed by monetary policy mistakes or credibility loss. And if you're in cash, you're paying an opportunity cost, but maintaining optionality in case this deteriorates. The smart money right now is doing what the market's doing, hedging, maintaining exposure to growth while keeping powder dry, watching the confirmation process, paying attention to who actually gets appointed and what they say. Because the truth lives in the footnotes here. When Hassett says Fed independence is really important, what he's not saying is whether the nominees will actually maintain it. When Warren criticizes the picks as lacking independence, what she's not providing is specific evidence of why. We're in that uncomfortable space where the controversy is real, but the details are sparse. Where the implications are significant, but the information is incomplete. Where everyone's taking positions, but nobody's showing their full hand. And that, more than anything, should make you pause. Not the controversy itself. Central bank appointments have always been political to some degree. But the gap between the rhetoric about independence and the actual information we have about whether these nominees will protect it. The market's going to figure this out before we do. It always does. Watch the bond market. Watch Fed speeches. Watch the confirmation hearings when they happen. The truth will emerge, piece by piece, in the bureaucratic language of Senate testimony and the price movements of Treasury securities. Until then, we're all reading signals in the noise, trying to distinguish between genuine threats to institutional independence and normal political theater. The difference matters. Your portfolio knows it, even if the headlines don't make it clear. Remember, nothing said in this podcast is financial advice. This has been another fire episode at What the Sigma. Smash that follow button and tap 5 stars to spread the butter. Fortune favors the bold, baby.
Grep News. Tamez.